Hi, gang. Larry Williams back here at StockCharts.com. Got to be everybody's favorite place to find out what's going on in the stock market, as well as the futures market, and probably the world in general. There's so many great contributors here at StockCharts.com, and I'm really proud to be one of them. So today we're going to talk about where there's smoke, there's fire. What do you think I mean by that, right? Well, I think there's a whiff of something in the air. If you watch television or go online, where there's smoke, there's fire. Look at what everybody's saying on television. The economy's about to stink. Here's Kelly's data tracker. The U.S. economy is going into a material slowdown, says Chief Economist Francis Donald. It looks really bad. Lawrence Summers, former head of everything in economics, and that was Carter or Obama, building consensus building towards an inevitable U.S. recession. It's going to happen. It's unstoppable. Deutsche Bank says so too. Wall Street Bank predicts the U.S. is headed towards a recession. Oh my gosh, this does not look good. We better start talking about, is this going to happen or not? Bank of America says a recession shock is coming. They chime in on this too. Inflation shock, worsening rate shock just beginning. Could be the end of the world. The sky is falling. I don't know. But we're going to take a look at that today. I have some things I think you're going to find really interesting about the recession, and a really great recession tool that has done a great job of spotting exactly when recessions come. And it's a shocker. Wait till you see this when it's coming up. I think you're going to enjoy it a lot. A really interesting twist I found, how interest rates can effectively tell us when a recession is going to come. More of the yield curve. I mean, if you followed anything on the internet or on the talking head shows, the yield curve has gone crazy. Everybody's talking about the 2-year treasury yield has gone into what they call an inversion, which means that 2-year yields are higher than 10-year yields. And the Fed chatter says this is less confidence. That means that people want a lot of more money for their money right now on short-term notes than on long-term notes. And according to all the talking heads, this is really, really bad. It's called the yield curve craziness, as I see it. It's a difference between a 2-year and a 10-year treasury yield. They've been inverted for the first time since 2019, setting a possible warning signal recession could be on the horizon. The bond market phenomenon means the rate of 2-year notes is higher than 10-year notes. And this is disturbing, because it means people that have money that are lending money out in the bond market want to be paid more for short-term notes and long-term notes. The only reason for that is because they're frightful about what's going to happen on a short-term interest rate basis. So they want to be paid more now. They don't see a good future is usually what the yield curve craziness means. That's what it's really all about. Now, it's inversion of the key U.S. yield curve slices a recession alarm. If you watched anything at all, you've probably seen this. This poor guy is associated with the recession alarm. Then they took this picture. But we really need to look at this. I want to put the yield curve today under the microscope to see what's just right. Can they all be right? For all these people talking about a recession, the yield curve, it's kind of like on Amazon. Have you ever gone to those Amazon reviews? You look at all the 5-star reviews, and a lot of them, to me, have looked kind of bogus. So I usually, when I look at Amazon review, go to look at 4 and 3 stars. But you really have to wonder, could all of these talking heads be right? Because we know by and large that when the majority of investors feel one way, probably the opposite is what's going to happen. So there's been such a plethora of these talking heads with bearish pessimism. I have to ask myself, can they all be right? And more importantly, let's look at the indicators to see. They may well be right. So let's take a close-up and personal look at the yield curve. And the best way we can do that, thanks to StockCharts.com. StockCharts.com has this wonderful yield curve. This is a yield curve over here, and this is how it was at the start of 1999. The yield curve was sloping down. That's negative, but that's also about a year before, it was in 1999, a year and a half, really, before the stock market came down. If we look a little bit later, still 2000, the yield curve is still down, and stock prices still continue to rally. So the yield curve may be negative, but it's not an absolute that stocks will decline right here, right now, once the yield curve turns negative. In fact, if we start looking at the yield curve in 2006, that was 2 years before the 2008 crash, it had been flat and turned negative, but it was way early in terms of helping us identify a major stock market high. And where we are right now, the yield curve has turned down. So we see about similar to what we saw early in 2006, prior to the 2008, 2009 stock market debacle. It was 2 years early. So we may be early today. We may not. That's the problem with the yield curve. Here's a better view of the yield curve. This is from the Federal Reserve System, and this goes way back in time. We're going back now to 1980s. Now, when the yield curve turns negative, that's getting below this dark line, this black line, which has just started to happen recently. That's when people, the talking heads, have really come out talking about it. But notice the recession, that's these gray lines over here. In every instance, we went negative in the yield curve prior to the recession, and often by a couple of years prior to the recession. So just the fact that the yield curve has gone negative does not mean that the recession is beginning today or that it will even begin. But we see that clearly it is a leading indicator, and there's been some quite time. In 2005, 2006, it went negative. So it's probably more important, if you're going to use the yield curve, to look at the threshold. Once it turns negative and then turns up, this threshold I marked off here, that's when the recessions have begun. Look at that again. So we turn negative, the market can still continue going higher until we hit the threshold. Turn negative, hit the threshold, recession begins. Turn negative, hit the threshold, it begins. And again, and again. Very brief, shortest recession in the history of mankind, 2020, the COVID recession, which is over in a matter of months. Well, here's where we are right here, right now. We've turned negative, but we haven't come back to the threshold. So if you're looking for a recession to start here, I think this is a really good indicator that you want to follow. You can do that at the Federal Reserve Bank of St. Louis. It's simply the 10-year Treasury constant maturity minus 2-year Treasury constant maturity. You can follow this. When we get up to that threshold, about 0.5, that's when we can start to have some serious trouble. Right now, judging in the past, going all the way back into the 1970s, 1980s, long-term history here, the way this really works is it's a harbinger that something may happen, may not. Look, when we turn negative also, 1996, 97, way before anything happened in the marketplace. So the bottom line here, which is probably what most of you are interested in, a inverted yield curve occurs when short-term yields rise above long-term. This typically foreshadows a recession. Not always, though. That's what you have to keep in mind. Here's the rub. The recessions do not occur within a predictable time frame following the inversion. The lead is varied from 10 to 34 months, and stocks have often rallied strongly following a yield curve inversion. So all those talking heads, they could be a little wrong about what's going on in the marketplace now, or they may be very early, or they may be premature. But just because the yield curve has turned negative doesn't mean that we're going to have a significant stock market crash right here, right now. So you really want to keep that in mind in terms of perspective of the yield curve. Well, the talking heads say it gets better or worse, I guess, depending on your perspective. Some are now talking about a global recession coming because of the war in Ukraine, because of the inflation that we've seen around the world. This is frightening stuff. A global recession, this is frightening. And it's something, again, that we need to examine. And that's really what I try to do here. I may have a wrong view of the future as well, but I'm going to have it based on solid evidence of looking at the past. Some people think I'm an historian. Some think I have a crystal ball. No, the truth is, I'm not a technician. I'm much more of a historian. I really like to look at the data. It's all in the data. So we need to look at this data and then come up with some type of a conclusion about what the data is really significantly telling us at this point, as opposed to just listening to people, because there's always somebody very bullish, always somebody very bearish, somebody calling a recession all the time. So we really have to look at the facts behind all of this. Here's for sure a recession is coming in 2023. Yes, and here's why. Well, they're absolutely certain a recession is coming. Well, it may or may not happen, would be my view. Let's look at the data of what's behind this, what drives recessions. And you've probably seen this market plunge, S&P will plunge 11% by the end of 2022, says Bank of America. Really? Let's look a little deeper. In other words, I've had enough of the talking head. Now, this was a band group a few years ago, but they probably could be economic talking heads as well in terms of the marketplace. Let's look at the data. And of course, when we think of inflation, which is the big thing right now, we go back to Jimmy Carter, don't we? Some of you probably weren't alive back then. Inflation was 10, 15%. Interest rates got to about the same number. I read this, so this is really interesting. This is a quote now. The deepest and longest lasting recession the United States experienced began in 1920 when Jimmy Carter was president. GDP dropped 9.6% in the second quarter of that year of 1980 and did not end until the fourth quarter of 1982. So the recession was from 1980, remember this is going to be critical, to 1982. So was that a golden opportunity for gold? Excuse me. Are recessions a golden opportunity? There might be an opportunity here for the gold market. Again, this is a quote. In most cases, as economic conditions worsen, gold prices will rise. So this should be a particular interest of gold bugs and people follow the gold market. In fact, the quotation continues. Therefore, if you're looking at gold prices, it's often best to review how well a particular country's economy is doing so we can get a handle on what's going on in the gold market. I like trading gold. It's a very broad market. It's a strong cyclical market. You can get in and get out of 100 contracts in a wink of an eye. It's a very tradable market. It's a real supply-demand market as well. So I like to really focus on gold. And when we look at gold and the potential of a recession coming, let's look at that. Let's look at that with just a little bit more depth. Here was the 1980. Remember, we just talked about the recession was from 1980 into 1982. And this is the price of gold that actually went down. Shocking, kind of, isn't it? Now, it rallied up as we got into the 1980 time period because of inflation. And then, whoa, it went down until 2001. So was that recession a golden opportunity to buy gold? Here's a blow up of that. This is when the recession began in 1980. That was the peak of the gold market. Then we had another recession in 1982. And well, you can see for yourself what gold did. Went down, rallied briefly, and went down again. So if you're interested in the gold market, I don't think you can bet on the gold market based on that we're going into recession. And that's sad because it's kind of a commonality that we would think if we go into recession, gold is going to be a harbinger, a place of putting money to be safe. But so far, what we've seen today, that's not necessarily the case. We get a little longer range view from our next chart from Thomson Reuters. We're going back to the recession in 1975. The gray lines, remember, are periods of recession. And as the recession started, gold peaked. In fact, look, after the recession was over, it wasn't a bad time to buy gold. And in 1980, as we went into recession, as we acknowledged the recession, gold peaked. And again, we had that recession in 1980. We had one in 1990, and gold peaked. And 2000, gold didn't do anything until after the recession. Then it had a big rally. The 2008 recession was a really big recession in the stock market, big beating of the stock market. And the blue line is CPI index, by the way. So we see a CPI and gold pretty much move together. And once that CPI turned down, well, it was all over for gold until the end of the recession. Isn't that interesting? It almost looks like it might be better to buy gold at the end of the recession or hop it as we get into a recession early on as that CPI index picks up. But once a recession is announced, gold, at least going back to 1970, has a pretty strong history of rallying more after the recession than when the recession starts. It rallies leading up to the recession. These gray lines show where gold starts to pick up a little bit, It rallies into the recession, but once we're in a full-fledged recession, despite what the purveyors of pessimism are telling you about the stock market relationship and gold, it doesn't look like gold has any significant rallies during recessions. In fact, more often we've seen declines as the recession starts. Now, this is the critical point. Leading up to the recession, gold can be strong. But if we do get into recession, I think you want to take the short side of the gold market, or at least delay any long-term purchases for gold. Here's a blow-up chart so you can see this a little bit better. This 1990 recession, and this is producer price index gold or mining. This is the basic price of gold. This is another Federal Reserve chart. During the recession, nothing happened. During the recession, nothing happened. The 2008 recession started, gold went down. After the recession, gold went up. So hopefully I've shown you some data today that you've never even heard about or never thought of, haven't seen this, but certainly this is a wake-up call about what gold does as a recession starts. Notice it rallies up to the start of the recession. Once gold tops out, it's probably when the recession is starting, as full-fledged, full bloom. Isn't that interesting? Again, as gold comes down, that's the start of the recession. You might want to keep that in mind. And the start of the recession has usually been a pretty good place to sell gold. The end of the recession, a good place to buy gold. I've blown it up again so you can see us a little better. In January 1980, that's when the recession was announced. Good place to sell gold. At the end of the recession, not a bad place to buy gold. The 1981 recession, the recession starts, gold goes down. After the recession, then we get into a more tradable market in gold. So that's the history of gold and recessions. And I hope that's something you will kind of keep in mind and learn a little bit from today. Really, it's just a joy for me to show you these intermarket relationships, how things really work, because there's so much emotional talking about, oh, the market does this, the market will do that. But in actuality, if we really look at the history, that's why it's probably better to be an historian than a technician. You have a lot better depth into the markets and give you better holding power, because at times you'll be under pressure in the market. But if you understand the history of the market, you're going to be a lot better. So I thought you might like this. This is my gold cycle forecast of what I think's scheduled for in the gold market, that we're basically should see gold start to come down. We're looking at a weekly chart here now until sometime into June. We can have a rally up into the 1st of August and another buying opportunity in late October. Now remember, this is a cyclical forecast. That doesn't mean that we're going to have a big rally. It just means that we should see a low point here, a high point over here, a buy point over here. Now, this was a big rally, but this one wasn't. So cycles don't tell you how big that rally will be. It just says, look for a buying opportunity the end of May, start of June, the first part or middle of October. So you longer term gold people may want to keep that in mind. And currently the cyclical influences of gold should be the downside. Again, that doesn't mean rush out and sell gold today. That means you would take gold sell signals if and when they occur on a longer term perspective of the market. Okay, so that's the gold market. Now, oh my gosh, let's get into inflation. That's been the buzzword every place, right? It doesn't matter where I have gone shopping this week, where I've talked to people on the internet, my fellow stock traders, everybody, it's all about inflation. So inflation, we generally think is caused by more dollars in circulation. Maybe not. It could also be caused by a scarcity of the product. If there's no eggs around, people will pay up for eggs. So it isn't just dollars in circulation. It can also be a scarcity of product. And it looks to me like that's a lot of what's driving higher prices right now. Clearly, there's been a lot of money in circulation too, but there's been some product scarcity, which suggests to me we have two things in operation that cause inflation at this point. But I think this might be an important point. What if wages increase at the same rate as prices increase? Is that inflation? Because we usually think inflation is losing purchasing power. And so we'd have to say, well, no, we're not losing purchasing power if wages increase as prices increase. So that's something for us to think about. Clearly, we're inflating right now, but we have to say, are people getting compensated about equally to the same rate of an increase in inflation? Because if we are, then this beast of inflation can continue for a while and probably won't be stopped immediately, which typically the Fed has done in the past under Paul Volcker, just raise interest rates. I see the former president of Home Depot, the founder of Home Depot, thinks that interest rates should be the same as inflation rates, and that'll kill the economy. We would, without a doubt. I think, though, the Federal Reserve is a little more delicate now in how they approach stopping inflation. We'll see. This is really interesting development, but let's look a little bit more at that. The black line is inflation on a monthly basis. That's the CPI index. And you see we have a huge inflation starting in 2020. The cycles, though, and this is where it gets really interesting, the cycles suggest we're about at the end of it. Now, this has been a pretty good cycle forecast. Inflation should start to go down. CPI should start to go down, should start to go down, should start to go down, should start to go down. It's not a perfect tool because it's a cyclical phenomenon using monthly data, but it suggests that we are in the upper end of inflation. And we should see inflation decline until about 2026, when the next inflation up move should begin. Now, this has been pretty good at timing these lows in inflation, hasn't it? Look at that. Look over here, over here. So I'm not getting carried away with the fact that inflation is a given. It will last. It's going to be horrible. It looks to me like, cyclically speaking, at least, that we are close to a high in inflation, and therefore we should start to see inflation decline. And when it does, I think that's going to be a very bullish message to the world. No global recession. To interest rates, they'll start to decline a little bit. And to the stock market, people have more strength and a better optimistic view about the stock market. And it looks to me like we're not too far away in terms of cycles. And again, we're looking at monthly data here. Keep that in mind. I would think we're going to start to see inflation start to decline probably at the end of the third quarter, end of this quarter, or the middle of the next quarter. So somewhere in the June, July time period, my expectation is that we're going to start to see these inflation numbers start to shrink up as we start to form the cyclical high in inflation. So there's one man's view of the future of what most likely will happen in inflation. And wow, what an indicator this has been for the stock market. Grab your pencils, hold on to your seatbelts. Look at this. The red is the Dow Jones Industrial Average, okay? When inflation peaked, we're going back now to the 1950s, when we had a lot of inflation. Notice we had a lot of inflation, stocks rallied. But when inflation peaked and came down, whoa, holy Toledo, what a nice buy signal. Then in 1962, inflation came down, it started to come down, and stocks ran up. Here we see the same thing. Inflation starts to come down, stocks run up. Inflation, remember, that's the black line, rolls over, comes down. 1970, stocks go up. Inflation started to come down, and look at the low in the market. So as inflation peaks, we've got some really strong buy points in the market. It doesn't necessarily work the other way around. When inflation starts up, we can still be quite a ways from a peak of the market. Inflation turns up, we're a long ways away. Inflation turns up, we were close this time, but not always. But what has been consistent is when inflation rolls over, we're in the area of a stock market low. Inflation rolls over, inflation rolls over. Oh, what a point to buy stocks, right? Well, that was the past. What does it look like in the future? Let's update this, right? So here we see again, inflation starts to roll over. This is a 1970, 74 bear market low. Oh my gosh, inflation rolls over. Look where we are. In 1980, 1982, inflation rolled over, stock market low. Continued rolling over, continued being very positive for stock. Again, inflation picks up a little bit. Inflation starts to roll over, buy point. Inflation really starts to roll over in here. gets almost negative, great point to be a buyer of stocks. 1990, 1998, look what happened. Inflation was started to pick up, and then it rolled over. Oh, another buy point in stock. So this is a tool you've got to add to your repertoire, to your quiver of arrows in terms of significant buy points in the marketplace, the inflation buy signal. And here's the inflation buy signal updated. You can see what happened in 2000. We had a bear market. Inflation rolled over. We're close to the low. It dips again right at the low. We had a huge up move in stock prices starting about 2006. Why? Well, look what happened. Inflation had been picking up. It rolled over, and there's the buy point, that last huge up move in stock price. Then inflation picked up again, and it rolled over. It started to decline, and it was a little early this year, but it was certainly a good area to buy stocks. As that 2008-9 bull market began, inflation picked up, and when it rolled over, look where we were. Another buy point. We had another little pickup in inflation about 2015, and it started to roll over, buy point. And then as we started the 2008, 9, 10 area, 10, 15 area, look where we are. Stocks are strong. We had a big sell-off in the market. Inflation rolled over, time to buy stocks. Oh, just recently, the COVID 2020 bear market, a couple of weeks was all, but look what happened. Inflation had picked up, it rolled over, time to buy stock. So guys and gals, we gotta be looking at this. When inflation rolls over, if we see inflation CPI index down for a couple of months, maybe 3 months, something like that, but has a significant change, I think that's our next significant buy signal in the market. So that's something I want you to be really looking forward to here as we see this develop in the marketplace. Look for that inflation buy signal. The Federal Reserve just announced their economic projections, and that you really should look at these notes. These are from the Reserve Bank president, March 2022. When the Fed speaks, I really listen. They gave the midpoint of target range. This is what they expect. For 2022, their target range for interest rates was about 2.3, 2.5%. For 2023, and these are votes, how many people voted for that? They're voting for about the same thing. The deep end was down here. They're 2.7 for 2023-24. They believe interest rates are going to stay in this area. That's what they're voting for. They're not voting for a substantial increase in interest rates. You might want to keep that in mind. In terms of inflation, in December, they were projecting inflation in most of them in the 2.3, 2.4% area. In March, they've gone down to 4 point up, higher inflation in their voting. But voting about December 2023, they see inflation also starting to subside. The majority of them are voting inflation, thinking it'll be about 2.5%, somewhere in that area, and even less in 2024. So it looks to me like their actual votes, and this is the number that voted for these specific numbers, that's all started to turn down. That's their view of the future. Change in GDP, December projections, a big change here. So here's the big lesson. Look at this. This is the Fed funds, You've probably seen this chart before. Look at this though. When interest rates come down, they've been coming up and come down. That's the gray line. That's the start of recessions. Look at that. Let's go over that again. When interest rates have been coming up and come down, that's when the recession begins. 2000 recession, 2008, interest rates came up. When they came down, the recession began. 2020, when they came down. So watch out. If interest rates come up real high and start to come down, that would be a little more bearish time. So my bottom line here is things could be better. Some negative data has come in, but so far, no recession. The anxious index really says it best. Notice it's still holding down here below the threshold for a bear market or for a recession. Federal Reserve, probably no recession. Excuse me. And if we look at look at unemployment. Unemployment has picked up before every recession. It's still coming to the downside. This is what I think cycle suggests for the stock market. And if I look at the advanced decline line, which is an internal look, it also suggests a rally. Just about now, another rally around the 1st of June. maybe June 5th should be the next rally. And then September 1st, look for those 4 rally points. So that's it. Thank you, StockCharts.com. And this is Larry Williams for now saying stay positive and wishing you all good luck and good trading.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.